Hello. All righty. Time to start. Sorry to be late. Welcome to office hours for 29 July. We're back to fictitious capital as it indefinitely expands the domain of commodities. And so what we're going to look at today is interest-bearing capital, specifically because there's one article that focuses on it and bonds more specifically, but we're still back at the general topic of fictitious capital as not revenue itself, but a title, legal title, representing a claim on property or revenue. Now, I know that's a kind of abstraction. We'll get to why that is in a moment. What I did, of course, because this thing is, I made it really, really long and probably ponderous for the page it's on. But I did, and I'll probably reduce the size of it just simply because it won't get saved properly in Medium. But what I did do, as I usually do, is try to check my work using an LLM, and and I put a summary at the end, in other words. So, core concept today, fictitious capital. Central thesis is that modern capitalism is dominated by fictitious capital. And let me say that it doesn't mean that it's imaginary. It just means that it's a kind of intermediate form of capital. That's one way of thinking about it. Or it is a mediated form, and the varieties of forms that it takes. And these are, I would assert that these are material forms. Now, you can get in an argument about that, but the fact that they're in language, this goes back to my semiotic stuff, is that they're material. I mean, they are material. You have to, maybe you don't blurt it out as a noise in your face, but if you're reading it, for example, that act is material. That's the whole point of what I was doing before, is that while labor writ large, this goes back to the organic questions we were looking at before, that labor has many different forms, and cognitive labor, mental labor, is a form. And how is it organized? It's organized with language, and the production of language, whether it's blurting noise out of your face or writing text or typing text, whatever, that's a material act. And if you're being a good materialist, then you have to sort of think of it that way. I know that, when you get back to, Marx and then all the people who want to pursue labor theory of value, they sort of don't want to deal with it for a variety of reasons. But I think ultimately, from an organic point of view, in the 21st century, you're going to have to cop to it. And people do cop to it. So it's not like this is anything unique. It's just simply that some people who feel, who are more orthodox in their business about labor, because as we looked at months ago, the idea that that Marx is writing for trade unionists, that arguing for labor, arguing for the working man, et cetera, working people, working class. All of those things are more understandable if you're reading Capital as sort of the manual for the manifesto, the Communist Manifesto. So that's a simple way of thinking about it. But the fact is, there are 3 volumes of Capital, and Marx was getting there. He just didn't get there at the end, and then Engels stepped in and blah, blah, blah. So anyway, central thesis is that modern capitalism is dominated by fictitious capital. That is, financial assets, stocks, bonds, derivatives, securitized debt. And we might extend that, of course, to the obvious extension into real estate or land. People would love to just sort of separate those two, but I think that the reality is that ground rent exists, and it's not the only form of rent. And making money from these items as as rent and or as interest bearing things, make them more material. So as I've said before, months ago, that we're looking at kind of a second order abstraction. There's sort of the one abstraction between abstract and concrete, and then we're looking at some sort of, not a meta abstraction, but just a simple second order of abstraction. And I won't go into the math of it, but it still makes it material in that sense. Okay, so the financial assets represent a claim on future wealth. And this is that whole business about, that it's about time. It's about valuation in the future. It's about net present value versus future present value or future value, whatever. So a claim on future wealth or revenue are detached from the actual production of value. Now that detachment is not complete, or it's incomplete, or it's indeterminate, it's in motion all the time, it's mediated. All of those things are at work if you want to apply a concept of fictitious capital. This is not that different from David Harvey's position on what counts, because he's talking about it in the context of space or space-time. Because there's a world out there and it is in space time. So definition, as Marx described it, as capital that appears that this appearance thing is going to come back up again to generate value on its own, like a pear tree bearing pears. I don't know. This could be an LLM hallucination, because in no place did I see pear trees. But it's sort of interesting how it got to the pear tree. Anyway, but it's actually a claim on future surplus value produced by labor. So the point is, as even in second order, as a separation at a second order, is that there's some surplus value somewhere. If we're talking about real estate, there's still people running out there, with hammers and wood and a bunch of stuff. So labor is there somewhere. It's just that it seems not so much detached, but sort of articulated. That's a bad use of that word, but it's the way in which you can use that word. It is an articulation of the further mediation from labor. So, definition, mechanism. It arises through this thing called capitalization, where any regular income stream, that is rent or interest or tax revenue. So you can see where land comes back in here, but we don't have to mention it now. But all of these things that are possibly capital, rent is capital as in terms of as an asset, an asset subclass of some kind. And particularly if you're thinking of it as tax and other stuff, is treated as interest on a hypothetical capital sum. So this is that second order, is that it's not there in front of you, but it is a part of the stream, the movement, the flow that we're thinking about. And I know that sounds complicated, but it has to do with this other thing. And we'll see this. I won't fully explain it, but it does deal with the questions of liquidity. And lest you think that's unimportant, Trump is all about the liquidity. He doesn't give a crap about so much of anything else because he lives for the moment. And he's all about the liquidity, but he doesn't give a crap about other matters because he's a narcissist. So, and that's the fault. He's not a very good capitalist for that very reason. But he's really interested in creating liquidity, and that's kind of why he's trying to get, and he failed. Waltz, or whatever his name is, at in the Fed. It was their first meeting, and he didn't vote for higher interest rates, but he also said, well, we're just going to keep interest rates the same way. But it was his first meeting with the Fed, so we don't really know. But it's sort of that was interesting as well. Mainly because he's not performing for the audience of one in that sense. But, eventually things are going to move. There were 3 votes for higher interest rates out of 12 or whatever. So anyway, financial markets create liquidity, the ability to sell assets instantly. That's what's going on with the current war. is the up and down in oil prices or fossil fuel prices, is people are making money on the float. They're making because there's sort of instantaneous or high velocity transformations, which people are profiting on. So people are making money off this crap. And it's the same thing with a pump and dump operation, for example, the crypto, et cetera. Um, Trump made billions, and the people, the rubes, the suckers, lost incredible amounts of money, but he doesn't give a crap about them. So anyway, which encourages speculation. Liquidity encourages speculation. However, this liquidity is an illusion for the system as a whole. Now, this is a point that goes back to the Greeks, right? Is what is in front of you an illusion or not? Is it the shadow of an illusion, or blah 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 blah? So without getting into an epistemological thing, it's not completely a phantom. And as we talked about, there is a specter haunting Europe, blah blah blah. Um, Spectral things can be real. I mean, this is, that's the reality, of course, is problematic, et cetera, et cetera. But, you just have to go back to the fact that, we love CGI, but it's not fully 3D. It looks 3D, and you can create motion in it to give you the appearance of 3D. But if you go back to the geometry of it, the math of it, it's only 2.5D. I mean, that's going to the hardcore math of it. It's really 3D. Its dimensionality is not 3D, and I have a whole lecture for that, but I'm not going to yak now about that. So if everyone tries to cash out simultaneously, the underlying real value cannot support the claims. And this has to do with runs on banks and other stuff. And some of that's going on in Russia right now because of how screwed up their economy is, and how people, I mean, Russians are probably better at operating with cash and hoarded wealth or some other thing, because they can't trust banks and whatever. So that kind of low degree of instability, so they're much more shocked, I suppose, at that. So number two in my yammering today is on the revenge of the rentier. That is, since the 1970s, particularly post 1979, under Volcker, Thatcher, and Reagan, Paul Volcker, Maggie Thatcher, and Ronald Reagan, there has been a deliberate political and economic shift to empower rentiers, that is, those who live off interest, dividends, and rent. So rentiers as a class are those people who are, they live because of the interest payments of stuff, right? And it's the choice you get relative to the Mega Millions or whatever, the lottery. Whether you're going to take the lump sum or not. So at the expense of workers and productive entrepreneurs. So this is that separation. And these are not pure class divisions, of course. Everyone's got, a savings account or some blah, blah, blah. So, it's not as a rigid class definition in that sense. But the fact of it is, rentierism is really important especially for, people with a lot of wealth. Krugman, I think, did a recent article or whatever column on changing income tax, or doing wealth taxes rather than income taxes, which is really the way in which, in a very quick and dirty way, that the rich can be taxed. I mean, it's just a tax adjustment that can be made by the next administration. And yes, it will sound like socialism and blah, 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 blah. But, if it only affects all those rich people, I think no one will, they're not going to, it just doesn't matter, because we know all the differences. Bezos is making millions per minute. So, whatever. Anyway, monetary policy, high real interest rates were used to break union power, because that's that's what it was, and discipline the working class, effectively euthanizing the rentier in Keynes's original vision. And so it was reversed by under Keynes. Keynes, you see, had a classical or a neoclassical model in the back of his head anyway. His issue was other things like liquidity. Uh, I mean, that's what breaks off the difference between neoclassical perfection, as it were, and Keynesian imperfection, kind of fiscal demands. And kind of where we're going to go today is to talk about sort of liquidity. We're not going to fully get to liquidity, but we're going to talk about fiscal policy partially. I mean, military Keynesianism is exactly that thing, is that while they're not necessarily rentiers, but the fact is, if you look at the United States, is military procurement is done, by the decade or by 5-year contractual spans, which is the reason why there are all these procurement problems and scandals and other craziness. But it's not done all at once, and because it's not done all at once or done under one administration then another administration, because you get changes of policy stuff, you screw yourself automatically, which is what's going on now. The Trump battleship, for example, just insane stupidity at work. Anyway, class conflict. The economy is viewed through a three-class lens. That is, under Keynesianism, it's rentiers, the winners; entrepreneurs, those people who are squeezed, they're driven to do this. Trump is an entrepreneur. It's just that he's, unfortunately, has the power of the state and the treasury behind him, and he's screwing with that. And then workers, of course, who are, of course, the losers by proportion. And then there's political capture. The rentier classes capture the state using political power to create regulations. And those regulations are at work. We, in the current situation, NVIDIA is one example about intellectual property rights. And then there's limited liability and financial deregulation, all at work at the current moment. And you can see this in the details, financial deregulation, because, it should be a free financial market and blah, 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 blah. There are just other craziness and bankruptcies and inflationary stupidity that's at work. But anyway, that lock in their ability to extract wealth without producing anything. And that's the underlying issue, right? The productionist bias in the literature. That is, it's easier for Marx to talk about manufacturing, because that's kind of where all the workers were, than talking about financial capital, which he got to. I mean, he got to part of it. It's just, he didn't live long enough, or, whatever. It's been left to the rest of us to try and figure all this crap out. So I selected an article that talks about fictitious capital. And what she does, it's Carolina Alves at Cambridge. She's thinking about it more specifically. She takes one category, that is bonds, and sort of works out why, because of bonds related to public debt, is why that fits into the fictitious capital model. And it's one way to approach the problem. It's not the only way to approach a problem. And as you've sort of seen with my fiddling around, is that it's only one element and a bunch of things, that when we get to quantum ideas, that it's just sort of one element among many, but it's a big element. And I'll show you in a chart why that is. So anyway, and this idea about extracting wealth without producing anything, sort of this goes back to the issue of unpaid labor, because strict Marxianism, some people are they believe that, for example, creative activity isn't real labor. It's that whole thing about that you should have a real job rather than make art or whatever. This is that problem about, it's a stereotype. It's a prejudice against quote unquote unpaid labor. No, every creative act has labor built into it. Every creative act, in that sense, Anyway, profits without accumulation, that's the result of thinking that way. So this is the productionist point of view. A major phenomenon identified is the decoupling of corporate profits from investment in production. And see, this is the difference between Department 1 and Department 2, production versus distribution, or, whatever, circulation. So the enigma, since the 1980s, profits have remained high or they've grown, while investment in fixed capital has stagnated or declined in wealthy nations. That doesn't even address the issue of, incomes, versus profits, or whatever, wages versus profits and wealth, and et cetera, that Piketty is looking at. The cause, now what's the cause? The cause is on a different scale, or a different sector. And some of the people I've been looking at, Duran, Orlean, discriminate or distinguish between more hardcore finance and things that have to do with non-financial capital. And yes, there's a significant amount of non-financial capital out there, in all kinds of shapes and forms. But anyway, uh, uh, but there's a shift that has gone on since the 1980s from conserving and reinvesting, and there's a whole argument that follows from that, to restructuring and distributing. And it of course explains a lot of things. It also explains, inflationary, stuff, and predatory other stuff. But anyway, shareholder value as one aspect of this, because of stocks, etc. Management is pressured to maximize, and we've had this critique before, this has been there for a decade or two, maximize short-term shareholder returns via dividends and stock buybacks. That's sort of the standard, corporate critique literature, that is that, corporations spending more on stock buybacks than actually developing the business, or, redistributing, CEO income to the workers, or even middle management. Anyway, so financialization of firms. Companies increasingly generate revenue, not from selling goods in a commodity sense, but from financial activities, which are also commodities, that is, trading assets, holding cash in financial instruments. So you see that going on right now. It's why, we're at an inflationary level. You have fiscal military Keynesianism, a stupid war, profit, looters, ruling class looting going on. And that's kind of what's going on. And so you have globalization, which is still part of this. That's kind of why the Hormuz thing is the real problem. Profits in the global north are often extracting value, that is, imperial rents. Unless you think that's unimportant, imperial rents are what's going on in Venezuela right now. Imperial rents are being extracted because Venezuelan oil, rather than going to China or some other place, is going to the US. It's being refined in the US, just being diverted. And then there's other imperial rents at work there, but that's kind of the simple version. From the global south rather than domestic accumulation. And yes, Venezuela is technically in the global south, even though it's an oil state. And yes, it has incredible reserves. Number 4, the role of the state and government bonds. The text challenges the view that my little text here, that is all the things that I've collected here, challenges the view that government bonds are merely a tool for deficit financing. And many people just simply think of them as that. And yes, that's what they are generally used for, and particularly at regional or more local levels. But there's a keystone of finance, that is, government bonds are the primary form of fictitious capital that underpins the entire credit system. They provide the safe assets and collateral that allow private banks, and this is private banks writ large, to create credit money. And yes, credit money is even thought about by Marx. Inescapable debt. Because the financial system relies on the liquidity and safety of these bonds, public debt can never be fully paid off. It really never gets paid off. And the worst form of that, of course, is war debt, for example. I mean, that some bills from World War II have not been fully paid off, and I'm sure there's Korean War debt that's going to go on for decades. It must be constantly rolled over to maintain market stability, and that's the other issue that it's part of the churning of this. So, political profit, state effectively subsidizes finance through quote unquote implicit guarantees. So, the implicit guarantee from 2007-8 is bailouts and lenders of last resort. And now, of course, Lehman Brothers is gone, but there were bailouts and the accepting by the state of toxic assets and blah, 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 blah. Allowing financial institutions, and this is the side part of it, of course, the difference between public profit or public debt, to privatize profits while socializing the risks. Now, lest you think that's unimportant, this is the kind of shifting of costs or risk back and forth between private and public sector. And of course, there's an asymmetry in it, as I've talked about before, in terms of the difference between public-private partnerships, the three Ps, is that they're always asymmetrical, and business gets more out of it, or business gets more from it. There's an asymmetry about what the state gets or the public gets as opposed to what the private sector, whatever that means, corporate, whatever. And lest you think that's unimportant, that's kind of what's going on with the little, the reflecting pool thing, where there's corruption and overcharging and blah 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 blah. The risk got socialized simply because it came out of our pockets technically. And, well, anyway, you can figure that out. Consequences: instability and stagnation, which is exactly where the current economy is. Systemic fragility, the expansion of fictitious capital, creates a quote unquote house of cards. It preempts future production, leading to bubbles. Yes, there's a housing bubble. There was a housing bubble in 2007. There was a dot-com bubble at before 2000, before we got into a war, and that inevitably burst, causing crises. Now we know this. I mean, there's a history of it. It goes back to tulips, and there's ways of kind of avoiding it or kicking the can down the road, and that's kind of what happens in modern capitalist, the modern capitalist economy. All right, stagnation, which is kind of where things are going now. The drain of profits to rentiers. Yes, there are rentiers. Trump is a rentier, even though he probably wouldn't admit it. And the aversion to long-term productive investment lead both drain of profits and aversion to long-term productive investment lead to secular stagnation, low growth, and rising inequality. This is the Piketty thing. Growth has been, it's beginning to fall off. And yes, of course, there's growth in the regional sectors, and there's differences between continents, and but yet in all of this, there's still inequality, right? PRC has this, Russia has this, the Saudis have this, anyway. Managerial feudalism, and this is that business where we, like Varoufakis, talking about, we're in feudal territory, or it's become feudal, and the cloud is, the manor. Then in the middle kind of state, there is a managerial feudalism. The system has evolved into a form of quote unquote managerial feudalism, where a small class of financial elites extract rent from the real economy using the state to enforce this extraction. The simple version of this, of course, is everyone who has a subscription to something is giving up rent money. I mean, subscriptions to everything, and kind of that portion of the economy needs a lot more work, clearly. And of course, it punishes poor people more than it does rich people. So my little business here, concludes that the current financialized system is not a natural evolution of the market. There's a whole critique of this question of how you see, this is the first moment that market gets mentioned, and this is an inverse of what we would normally talk about. People would talk about, well, the market is blah blah blah, the more important, and blah blah blah. But markets are always important. Even in a socialist or communist economy, there are markets. You just need to think about them differently. But a political project designed to transfer wealth to the rentier class. Now, rentier classes are, you know, Nepo babies and their trust funds are a rentier class. Let's put it that way. That's the crude, vulgar version of it, but that's kind of what it is. Aside from, retirees and et cetera, et cetera. Um, and there are people running out trying to manipulate this in different ways. Trump has a thing that he's named after himself, a Trump baby accounts or whatever the hell they are. I mean, he didn't invent this goes back. There's several Democrats who are actually part of this idea of this is the same thing as Christmas accounts or whatever, but for children, and it promotes having kids and creating savings, and that it does shift savings down to the lower classes, etc. Anyway, current financialized system is not a natural evolution, because that's not a natural evolution of the market, but a political project designed to transfer wealth to the rentier class. It is inherently unstable because it relies on the continuous preemption of future value. Now, preemption of future value is, converting funds of, that you might normally need to just survive to certain types of savings accounts, some of which are good, some of which are, predatory. With all due respect, I don't have money in a 401k, but the 401k was created, in other words, to privatize, as it were, certain ways in which you invest money. So, and of course, it's problematic for all the usual reasons versus what an IRA does, and blah 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 blah. The market is not a neutral allocator of resources, but a mechanism, and this is where Harvey and a bunch of other people come into play, is that dispossession is as important a mechanism as extraction. Dispossessing is not the same. It's similar. It's a family resemblance to extraction, but capital is engaged in that as well. Where the state, and the dispossession position is the role of the state. The state is used to guarantee the claims of fictitious capital, often at the expense of social welfare and democratic control. Now, this point of critiquing the state is really important, particularly to the left, because, on the one hand, you can get a whole thing about the problem of the state, that from one political point of view, the state's supposed to wither away. And from another point of view, you need the state in order to, manage all this, to control the terribleness that capitalists create. So there's that. So this is the short version, the summary of what I was going to yammer about. And I did all kinds of other things that do details on what counts as capital, liquidity, and stuff. That's at the end. So we begin at the beginning, as I usually do. Back to fictitious capital. The idea of fictitious capital is what the thread for today, as it indefinitely expands the dominion, and this is dominion means a lot of different things. If you're religious, dominion means all kinds of things. So dominion of commodities has a kind of dominion, and in the economy, it's why Marx, switches the second edition, third edition, or whatever the hell it is, to commodities at the front end. So interest-bearing capital, IBC, and fictitious capital exist as titles representing a claim on property or revenue. So title obviously has a legal implication that goes to what I was yammering about before, about sort of law and political LPE issues, which have to do with that legal things like contracts, etc., are part of the big problem, part of this second order sort of, I'm using that as a more of a metaphor, but in the math, it actually sort of works out that way too. All right. I mentioned before turbulence, and there's a word for turbulence. It is the way in which, and I would assert that Anwar Sheikh is thinking about Robert Brenner's work on turbulence, global turbulence, and putting it in his sort of magnum opus on capitalism and competition. So turbulence and euthanizing the rentier, euthanizing the rentier, if you're following Keynes, is this idea that we shouldn't, this is a perfection issue, an idealist issue, that in a fully functioning economy, even a communist economy, you would have to euthanize, that is, kill the rentiers because, they're parasitic in that sense. Now, the point is that, your granny is on her, pension. On the one hand, is a rentier, but, you don't think of her as a parasite. But the fact is, a fully functioning economy wouldn't have this kind of class of, sort of unpaid stuff going on. In the context of working class entrepreneur and rentier, so you can have these three divisions, a Keynesian division, can turbulence, the question I'm asking is a research question, this is the big question as opposed to the little questions, can turbulence, this kind of agitation, which follows on Marx's approaches to crisis, the economic crisis that is, periodic or episodic. Can you use turbulence to give democratic commitments institutional form? So the point is, can we get to democratic socialism? I mean, one way of thinking about it. Can we get to democratic socialism of a kind quickly and institutionally with only a few adjustments? And with all due respect, because I'm unfortunately an idealist about these matters, is that some adjustments can be made quickly. And as we've seen, the right wing has worked quickly to put in their little Christian nationalist stuff. And they've worked pretty quickly, even though they've obviously been beaten back. And that hopefully in a couple of months, we can turn all this back. But you can see how quickly change can happen in awful ways, right? Abortion, rolling back all kinds of crap. And that has unfortunately happened quickly. Turbulence is not a failure of policy to restore equilibrium. So that's one way you can think about this churning that's going on. But the natural state of a complex, entangled, and politically observed system where, and this is where quantum comes in, probability amplitudes should favor democratic outcomes, that is, in employment or housing, over rentier extraction. Now you can see that rentier extraction is more important to certain capitalists, and they don't give a shit about a fig about employment as long as it stays below a certain unemployment level, and it's kind of forcing people to defect or quit the labor market, et cetera, et cetera. And then the housing issue, of course, you have an unhoused underclass in the streets, when in fact the reality is there's sufficient wealth in the United States to house everybody, and no one should be without that, and everyone should have an income because we can afford to do it. We can simply afford to do it, but people have other ideological agendas going on in the little brains. Why should people of color get stuff? But the reality, of course, is that there are more white people on general assistance than there are folks of color, but they don't think about that, and it's just ideological false consciousness, etc. So this would structurally require the euthanasia of the rentier, not just as a moral goal, because that's what I just sort of mentioned, that eliminating rentiers would mean that we don't have to worry about that stuff. We're in Star Trek country. But as a mathematical necessity to collapse this wave function that we see, proceeding back and forth, that creates these, sequences or cycles of problems into a stable democratic reality. which is not the same as what libertarians want. Libertarians want the churning. They like the conflict. They like the fact that they have to fight with people or hire cops to, kill people before they get into your gated community or whatever. Now, if we think about capitalism, among many things that we can think about it, we can think of it as a series of contingent collapses, and this is the quantum thing, superpositions, which is code for thinking about the same thing from a Marxist point of view about uneven development. Now, normally in the North-South discourse or whatever, uneven development seems relatively asymmetrical. There's North, there's the wealthy North and the poor South, but that's not the reality of it. The reality of it is that, Caracas is pretty well developed as a city, even though it kind of functions really horribly, and it's got a military and it's got socialists running around, and then it's got Chevron. So you've got all that other stuff going on, and it is uneven, and it is being, northernized in that sense. So rent, to go back to the rent issue, rent is only one feature of a whole bunch of other things, but it is a very significant part of any economy that is seeking rent or creating rents or things that would support you as a rentier because you've got free time to do crap, whatever, you've got children, whatever. All of these things are important from a wealth building point of view. Rent is the income from real capital, but the reality is, of course, in rent is the trading of the rent stream, which causes or creates fictitious capital. So to go back months ago, the difference between use value and exchange value, or to simplify that, the difference between value and use value is about exchange, is about trading, is about the motion and movement, the flow of all this stuff. And yes, it's really complicated, but relatively, you can aggregate stuff. You can get data that kind of works this out. And, it's not as hard. And we have computers now, so it makes it a lot easier to work with. And so it's not as problematic, even though, people have been being taught that it is. So Marx described fictitious capital as capital that appears to generate value on its own, detached from the actual production process. Department 1, Department 2 again. And that's one appearance problem. And remember, going back over my yammering, that you have multiple circuits that are overlaid, that are as it were nested sets of activity that aren't all the same. They're not identical. They don't, they're not contiguous. They're not synchronized in that sense. They can become synchronized, but that doesn't happen in reality. You may have this ideal that synchronizes it, but that's just not what happens. People are constantly making money, or predation occurs, preying on people. That's kind of part of the unevenness. So rent becomes fictitious capital when it is capitalized and traded as a financial asset. Rent might be viewed as existing in a superposition, that is an overlapping, as it were, but it's not a single moment. This is a multiple superposition, and from a quantum point of view, of value states, that is, multiple probability states, until it gets observed. This is what a market is for. That is, that's the communication problem in a market. And it's realized in all kinds of ways. Simple version is, decisions that are made on price and not, which are not identical to value. And yet, you try to reduce one to the other, etc. So how is rent extraction seen as entangled, more quantum stuff, entangled with political power structure? And you can kind of see that at work. It's at work right now, because most people are paying more for their stuff. And one guy in DC is making a crap load of money off of, other kinds of activity that we don't see revealed, or we do see revealed in our daily lives, our daily consumption. So So how does rentier capitalism, that is in housing, or, and this is where we get to the tech bro issues or tech platforms, distort value creation? And unless we go into a whole bunch of things, this is the problem of, blockchain, uh, crypto, etc. That is, there is, rent seeking and rent creating behavior in there, but it also has constraints or limits that only favor, that have asymmetries and favor the pumpers and dumpers, for example, in the Trumpian sense. So if uncertainty principles metaphorically, and this is the problem I dealt with last time, is, there is a relationship between analogies, metaphors, and models at a theoretical level, and you sort of need those to work around that stuff. And lest you think that's unimportant, the Maxwell equations and all the other stuff we were talking about, physics behavior often is that question, Schrodinger's cat. All right, you need metaphors to sort of work through some of these issues, because it's harder to talk about particles than it is to talk about cats, I suppose. Describe the unpredictability of rent markets under policy shifts, speculation, or crises. Can they inform the model construction process? So what we're talking about here is developing theoretical political economy models that appreciate, not in a neoclassical sense, but in a more Marxian sense or a more socialist sense, uh, a kind of quantum approach to political economy. So that's kind of where I wanted to head this. And the problem, of course, in that thinking about it, most of the literature still privileges the neoclassical because the math works out better. Because the math doesn't work out as well, because it's a lot more complicated, a political economy, radical political economy approaches are necessary, but, you need to do a lot more work. So that's that. So the research question is, how important are nonlinear emergent behaviors in systems that critique traditional models of analysis? So the dominant thing for neoclassical, as for Keynesian modeling, is, linear processes, optimization, minimax, blah, 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 linear programming, etc. That's all easy stuff. It allows you to, quote unquote, engineer an economy. But the reality, of course, is that all that optimization and all that good math doesn't mean anything when you've got irrationality at work. They don't all cancel each other out in reality. So back to fictitious capital, because fictitious capital describes that degree of uncertainty or irrationality or indeterminacy. Marx described fictitious capital as capital that appears to generate value on its own, detached from the actual production process. Now, the point is that it's not a simple door between Department 1 and Department 2. Rather, as I've said, it's overlapping circuits that are like nested sets that, they're all kind of working in this flow that is really difficult to keep track of, but, it can be. And that's where quantum comes in. Rent becomes fictitious capital when it's capitalized and traded as a financial asset. Now, of course, it's only one element of what counts as rent, and particularly when you think about land rent, et cetera, because there's always, there's a difference between ground rent and rent for your condo or whatever. So we talked about legal titles. Now, this is from the article that I'll probably read from to close our little yammer session here. In the Alvis article. And for me, this is useful because it describes the complications that come or that evolve from thinking about a fictitious capital problem that can integrate things like rent, but also other things, into rethinking capital. And it doesn't change the capital. The total of capital doesn't really quite change. What we think of, these different levels, layers, surfaces. That's why I use the, layer cake as a sort of example, is that there's many things going on at once, and you have to sort of be multitask or multidimensional in your thinking. Fictitious capital encapsulates the trade and circulation of financial securities and exemplifies the mechanism that any regular income can be capitalized, turned into an asset, and then further exchanged in the financial markets. That's kind of the basic thing of how they work. Now, but the issue is that fictitious capital is the kind of lens against, with which we have to, and it's kind of like a funhouse or a kaleidoscope. It has other issues. Fictitious capital exacerbates the appropriation of surplus at the expense of other capitals. And note capitals as plurality, as plural. The conventional literature does talk about it this way. Marx talks about it this way, and it's not one big capital, but rather lots of little or component capitals, and increases the inequalities among capitals. There are inequalities that is, indeterminate, et cetera, and that's kind of why it is the way it is. The difference between stock and flow, and et cetera, et cetera. So. And this is the algebra for it. That is, it transforms m dash m prime into m dash, and in brackets, m prime dash m double prime. This is what I mean by a second order, where the total amount of surplus value produced is then reduced by m double prime. And this is how the math works. The math is easy on this in that sense, which represents returns on tradable financial investment contracts. Now, that's easy for anyone to say, but doing the empirical work is the next, real problem. And yes, people don't approach it that way. And with respect, there are Marxist accountants. There are Marxist accountants. They are primarily in the British Isles, but there are actually Marxist accountants out there, and there are ways to think about this in ways that work out from a not only a firm accounting or regional accounting or you know sector accounting, but also national accounting. Now, the current work done by people like Sheikh, et cetera, are doing the empirical work at very large national levels, which is fine, but it's an aggregation problem. You're dealing with big movements to show, yes, well, there is actually exploitation, or there is actually a decline in the rate of the rate of profit and capital, et cetera. And you can prove it now. It's provable. But what does that get you? What does that get you? Does it get you the revolution? Don't think so. Because most people don't appreciate that analysis, that's what's wrong with the system. Most people are more concerned about, getting to work or whatever. So anyway, there are details, layers. Loanable money capital, LMC, interest-bearing capital, IBC, and collateralized debt obligations. And this is the texture, the layers in our little layer cake. So the article I chose after the first, I moved up in my little thing here, A Turbulent Capitalist Economy, the Vision of Anwar Sheikh. And this sort of shows kind of the econophysics, why an econophysics, approach was necessary to connect things like Marxian stuff with classical, as opposed to neoclassical, political economy. And Sheikh's work is very much in the classical tradition, but his work should really be seen as a colossal effort to reanimate it, like Frankenstein, as well as to address its various lacunae, such as not lacunae means gaps or shortcomings, such as not having a very good, this is where we are now, a very good theory of finance, or not having a clear theory of interest rates. And yeah, we may think that we have a clear theory of interest rates because, yeah, we got algorithms. Yeah, we can do this. Yeah, people, day trade every day and screw around with that stuff. But we really don't have, the models are still much more complicated, but people are working at it. There is a whole sector that is doing quantum analysis for finance. The problem is, of course, they don't explicate it in a variety of more important ways. Like, for example, there's a field called financial geography, which does not truly appreciate the fact that it might have something to do with quantum algorithms, etc. But anyway, as he puts it, that is Shake, his is an archaeological effort, not unlike David Graeber's work on debt, at understanding the ruins of past arguments and to reimagine them in the current age. So, nothing is new in that sense. Sometimes we have to, be Indiana Jones or whatever and go back and dig crap up. So, and then I included, and we read this last week about Slavoj Žižek on quantum history, which is sort of another way to think about it. Oh, damn it. Oh, my charts got disappeared when I transferred them to a different browser. So I apologize for that. Some disappeared, and it's for a variety of stupid reasons about whether things got published or have proper links on the whatever. Anyway, the point is, and so several different literatures I've been looking at. Orleans, who is the person to which Durand's work is associated, gives us different ways in which we can think about fictitious capital. Now, the one place where it's not quite so useful is, banks, the basic bank. That is, it's a place where you keep your money. But then there's public debt, which is the next sort of level up, where things, you have debts and credits and bonds and that stuff. And then further on, at even higher levels of speculative action, are shares. And so, and which have, articulated in a whole variety of different ways. So fictitious capital embodies all three things. It's just that they do it in different strengths. So if you go to the regular page here, you'll see the chart that I took from Durand. And it's pretty useful, actually, if you want to just think about capital. So this is the money quote from Carolina Alves's article, which I'll start in a second. As titles of fictitious capital, the functionality of government bonds extrapolates the needs of state financing to either cover deficits or stimulate AD, which is aggregate demand. Its functions are not mainly associated with bond finance deficit expenditure and the fiscal stimulus, but see, already there's Keynesianism there, but rather more directly related to financial market liquidity. So the two elements here are trying to take a kind of solid or conservative position, and this thing that Keynesianism is really about in terms of fixing an economy is liquidity. So financial market liquidity, portfolio diversification, which is part of that, returns on real and financial investment, which is where we get more complicated things like real estate, et cetera, and price setting of real and fictitious securities in general. So, as I said, there's sort of a first order way in which we can think about this, but then we have to go to this second order thing to sort of get it to work out. And with all due respect, there is an indexical relationship between these second order things and the first order things. So government bonds are at the heart, and this is the argument that Alves is making. Government bonds are at the heart of Marx's theory of money and the credit system. Now, there's a lot there because, with all due respect to modern money theory, we're still working through this, in terms of getting a coherent discussion of a modern money theory without having to talk about Marx, which is kind of what MMT does. And spends a lot of time trying to disclaim its connection to Marx, which is silly. But and in fact, credit and debt are, a modern money theory would love to not talk about that, but that's kind of what you still have to talk about. Now, Orleans, in table 7.1 in his text, he does a text on finance, and Durand takes his general structure of his model for fictitious capital from that. And it talks about, and this is the simplified version of the difference between defines differences between capital and liquidity, because they're obviously what we're talking about. And he contrasts a neoclassical model versus a quote unquote self-referential model of financial competition. So what we're doing is, yes, we're still talking about a market here at some moment, but different characteristics that represent kind of poles or polarities in that way of thinking. So in capital, we think about immobility as opposed to the negotiability of liquidity, profits, and the difference between that and capital gains, which is a big issue for many people. Enterprise versus speculation, which hopefully is obvious. Productive capital versus the second order. Productive capital being manufacturing capital, factories, etc., and financial capital, obviously. Long-term strategies versus the more immediate market-based strategies, fundamental value versus quote-unquote market opinion, which people spend far too much time on, fundamentalist rationality versus what I would refer to as self-referential rationality, the irrationality of self-referential rationality, negative feedbacks versus positive, and stability versus instability. And so these are kind of ways in which you could, and with all due respect, this is a structural approach to discriminating between a kind of neoclassical finance and a quote unquote self-referential finance. So objectivity of value is clearer between the two, that is neoclassical and self-referential, in table 8.1. Behavioral finance, and for all of the reasons that, what's his name gets Kahneman gets his Nobel, is behavioral finance, where you can actually see some objective measures that are more material, more real, more experimental than the way that neoclassical finance has set itself up. So that's the difference. Now, in terms of allocative efficiency of a financial market, behavioral finance doesn't quite do that, and definitely doesn't do it in self-referential finance. It's not about efficiency. It's about greed. It's about accumulation. And then individual rationality, behavioral finance doesn't, it looks at more collective form or more multiple individual methodological forms of rationality, which is problematic for all the usual reasons. And which is part of the assumption, the methodological individualist assumption of neoclassical finance. Whereas in self-referential finance, it's the Wild West. It's how, Russian capitalism operates, or whatever. Oligarchic capitalism works out. So, and then there's a thing on liquidity and speculative, what self-referential speculative rationality might look like. And then I do a thing on the market, Roshan's work. Here it is. So to close with my yammering, and remember that LMC is loanable money capital, IBC is interest-bearing capital, and CDO is collateralized obligations. And there's just a bunch of other acronyms, and you can plow through this. It's not a hard article. It's actually a very easy article, and the fact is, she's very careful about what she wants to look at, and she's not looking at private debt. She's looking at public debt, and that's really important if you're a radical or a socialist, because you're trying to work out those problems when you achieve, or if you can achieve, things that you need for social welfare, which, that is social welfare, not in the dole sense, but social welfare as redistribution of income, or trying to trash inequality, which is kind of the whole business. This is why we read Piketty. It's why, you need to have revolutions. It's need to class struggle and all that stuff. The only way that you can solve those problems is, or not the only way, but one way in which you do it, is that you build a state apparatus that deals with questions of debt in a much more comprehensive and integrated, fair way, equitable way, equanimitable way. Anyway, this paper, this is the abstract. This paper, and I have been yammering too long, so I won't probably only would get past the abstract in the first bit here. This paper is a theoretical contribution to the development and update of Marx's theory of money and credit. And so there's a lot quoted in here from Suzanne de Budoff's work and on money, which is, decades old, but really important because before there was modern money theory, there was actually, some people thinking about Marx's approach to money. Anyway, given the empirical developments in finances in the 1970s, the 70s are kind of where it begins for all the, structural reasons and neoliberalism and blah, 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 blah. It expands on the discussion of fictitious capital. See, we're right back there. And government bonds within the Marxian literature, in contrast with most Marxian literature and some of Marx's own writings on the topic. I argue that, as Alves argues, that fictitious capital does not represent any real capital, and then further develop the idea that fictitious capital is the channel through which the dominance of IBC, interest-bearing capital, over other forms of capital occurs. And lest you think that's unimportant, this is, interest-bearing capital gives us a bunch of other things, deficit financing, all kinds of stuff relative to credit and debt. That, and of course we see that other people are screwy about it because they don't know anything, and they're like demand that the Fed, bow down to his need for liquidity. Anyway, this interpretation lays a foundation for understanding why government bonds, as titles, legal titles of fictitious capital, they're only one of many different ones, as I said before, because real estate and rent does that too, are the keystone of financial markets and an unavoidable source. You see, talking about bonds doesn't help talk about 2007, 2008, the crash. Bonds are not as important, but they're still there. They don't disappear. And an unavoidable source for both financial accumulation and exploitation, rather than being a mere consequence of state spending. Because most capitalist analysts don't like thinking of, it's just, state spending and, it's the piggy bank or whatever. For this reason, public debt can neither be avoided nor, and this is the important point, is public debt can never be fully paid off. That's kind of the real problem of it. So, recent discussions of forms and effects of financialization have spurred an interest in fictitious capital, but Marxian debates on the money and the credit system have generally neglected this category. And Bellafiore's work and Perlman, the late Michael Perlman, talk about this relative to crisis, financial crisis. That is to say that most of the Marxian literature up to the 2000s did not directly and extensively try and elaborate on the concept of fictitious capital. The interpretation of fictitious capital within Marxist literature is diverse and, yes, polemical. There's a lot of people who wave their arms and stuff. Points of tension are seen in how fictitious capital is thought to be assimilated into IBC, that is, interest-bearing capital, how fictitious capital produces surplus value, whether fictitious capital represents quote unquote real capital, and the very meaning of fictitious, because people just verge off into metaphors and stuff. The discussion generally occurs on two fronts. First, in the context of theories of money, the credit system, financing crisis, and second, within the debates on financialization. So we've seen a lot of this sort of with my yammering here. You've sort of seen where we've come from or where we're going in that. And then she does a kind of literature thing at the front end, which is really worth it, just to read it for that. I think and then she, boils it down to discussions about bonds, which, can be kind of deadly dull, but it isn't. But that's kind of the second half. I follow, that is, all this follows the widely accepted definition that fictitious capital is as I mentioned before, a title, legal title, representing a claim on property or revenue, but with two, and this is all this is two necessary clarifications. First, this capital results from any stream of potential revenue this includes land, right, or whatever, real estate, being capitalized as an asset. See, remember we talked about rent as an asset in the asset class, and there's a problem, of course, there with intangible, tangible assets, etc., and further exchanged as IBC. Yet, its existence changes the distribution of surplus value, and thus it should be treated as the same as interest-bearing capital, nor this is the point, nor dismissed. So you have this floating sense of these multiple things out there that, on the one hand, you can't treat it the same as interest-bearing capital, but you don't throw it away, because most people would throw this away. Second, representing a claim on property is, yes, it is, different from representing underlying real capital as the market value of these titles. When you commodify, you put them into a product market of some kind, follows an independent movement from changes in value seen in the reproduction process. This interpretation sets the foundation to construct a broad narrative, this is where the metaphor problem comes, showing how these titles of fictitious capital. Remember, when we talk about fictitious capital, we're not talking about fictional capital. We're talking about fictitious capital, are crucial to both the development and expansion of, yes, the credit system. Now, remember that the credit system is the other to the debt system, and it's not identical. It's not symmetrical, which in turn offers more insights into the understanding of sources of, as what we've been looking at from a quantum point of view, instability and speculative booms in the economy. And I'll do this paragraph and then go to the end to illustrate the significance of this original narrative for understanding the role played by these titles in the credit system. That is, Aldous, uses the case of government bonds, which is a type of fictitious capital in Marx. As such, in this paper, Aldous both pushes forward the understanding of fictitious capital and brings government bonds into the discussion of Marx's theory of money and credit. So, pretty ambitious. I assume she's going to have a book on this whole business and, whatever. So, let me skip to wherever the hell the end is, and I'll read the end and then we can stop. So there is a conclusion. There is a conclusion to the article. I'll read that and you can decide whether you're going to stare at the whole article or not. Fictitious capital in Marx is what is known today financial securities. Its emergence is because in capitalist societies, any stream of income can be capitalized, right? The rent from your second home, right, can be capitalized. I argue that these titles do not represent any real capital, but are termed capital because they guarantee a claim upon the value that is produced in society. So this is that second order thing. They are also termed fictitious, not fictional, but fictitious, because their capital value can be different from whatever are the value generating processes in society, which in turn gives rise to and supports, yes, speculation. Although these titles extend the limits, this is the whole Harvey thing on the limits of the capitals, limits of capital, limits of the credit system, they do not necessarily guarantee a future production of surplus value. This is where the value question breaks down even for Harvey. And they do not necessarily guarantee a future production of surplus value, which, together with speculation, that's the point here, makes the credit system prone to speculative booms and instability. That is Alvis, also argue that as titles of fictitious capital, the functionality of government bonds extrapolates the needs of state financing to either cover deficits or stimulate aggregate demand, AD. Its functions are not mainly associated with bond finance deficit expenditure. That's the important point. most people would think about bonds as financing deficit expenditures, but also that there is, from a Keynesian point of view, a fiscal stimulus, but rather more directly related to, and this is why a Marxian approach or a quantum approach would be useful, financial market liquidity, portfolio diversification, returns on real and financial investment, and price setting of real and fictitious securities in general. Government bonds are at the heart of Marxist theory of money and the credit system. Two important consequences emerge from this. Firstly, government bonds are an active tool in the hand of the state. Remember, this is a government bonds, and not only a passive consequence of public deficits. It's not just the government, raising money. It's got a lot of other institutional elements. For these reasons, government bonds and therefore public debt can neither be avoided nor paid off in capitalist economies. Secondly, we're getting close to the end. Secondly, in this context, government bonds offer an unparalleled and unavoidable scope for purely financial accumulation while extracting surplus value from society. Although the functions played by government bonds vary according to, this is Harvey's, spatial, institutional, and historical conditions, the underlying common feature is that via government bonds, the national wealth serves to provide liquidity for private financial markets. This is why Trump is making billions of dollars. I mean, he doesn't talk about it in that way, but in effect, all these little scams that he's doing, are part of liquidity things, charging the Secret Service $1 million every weekend for his golf game is part of that. Given that, as a title of fictitious capital, government bonds appropriate part of the surplus value produced in society. This is a form of exploitation, like Donald Trump, of the public for private gain on a systemic level by means of the financial system. This goes to all the stuff we've been talking about, and all those little scams and all the things that are going on right now that are part of that. You could say that Trump's desire to get a tax break for his entire family is part of that. For example, it doesn't have bonds connected to it, but it is, taking advantage of public wealth or public, credit or debt to, and he's going to get $100 million at least out of this tax scam that what's his name, Todd Blanche, is supposed to sign off on. So that's what we talked about today. That's the lesson for today. And I'm going to get off and go to the stop the share, and then stop the live stream, then the share.